Hello everyone and welcome back to our channel. Today we're going to talk about mutual funds, an essential tool for investors seeking diversification and professional management. In this video, we'll demystify mutual funds, uncovering how they work and why they're a popular choice for many investors. Whether you're new to investing or looking to expand your portfolio, join us as we delve into the fundamentals of mutual funds and their role in shaping investment strategies. Mutual funds pool money from multiple investors to invest in a diverse range of assets such as stocks, bonds, and other securities. Managed by professional fund managers, mutual funds offer investors access to a diversified portfolio without the need for individual stock selection. From equity funds to bond funds and hybrid funds, the mutual fund landscape offers options tailored to different risk appetites and investment objectives. Understanding how mutual funds operate is crucial for investors looking to build wealth while mitigating risk. Mutual funds serve as a convenient and accessible way for investors to participate in the financial markets. They offer diversification, allowing investors to spread their risk across various assets and sectors. Additionally, mutual funds are managed by seasoned professionals who conduct research and make investment decisions on behalf of investors. This hands-off approach appeals to individuals who lack the time or expertise to manage their investments actively. Furthermore, mutual funds provide liquidity, enabling investors to buy and sell shares on any business day at the fund's current net asset value. 1. Pooling of funds. At the heart of mutual funds lies the concept of pooling funds from individual investors. This collective pooling of resources allows investors, regardless of their investment size, to gain access to a diversified portfolio of securities that might otherwise be out of reach on an individual basis. By combining their resources, investors benefit from economies of scale, enabling the mutual fund to achieve greater diversification and potentially access investment opportunities that may offer superior returns. This pooling mechanism democratizes investing, making it accessible to a broader range of individuals and enabling them to participate in markets they might not have the expertise or capital to access independently. 2. Diversification. One of the primary advantages of investing in mutual funds is the inherent diversification they offer. Instead of putting all their eggs in one basket, investors gain exposure to a broad array of securities across various asset classes, industries, and geographic regions. This diversification helps mitigate the impact of individual security or sector-specific risks, reducing the overall volatility of the investment portfolio. By spreading their investments across multiple assets, mutual fund investors aim to achieve a balance between risk and return, maximizing potential upside while minimizing the downside risk associated with concentrated investments. 3. Professional management. Mutual funds are managed by experienced professionals known as fund managers or portfolio managers. These individuals are responsible for making investment decisions on behalf of the fund, including asset allocation, security selection, and portfolio rebalancing. Fund managers leverage their expertise, market insights, and research capabilities to identify investment opportunities, monitor market trends, and adjust the fund's holdings as necessary to pursue its investment objectives. The presence of professional management provides investors with peace of mind, knowing that their investments are being actively monitored and managed by seasoned professionals dedicated to optimizing performance and navigating market conditions. 4. Share ownership. When investors purchase shares of a mutual fund, they become part owners of the fund's underlying assets. Each share represents a proportional ownership stake in the fund's portfolio of securities, entitling investors to a share of any income generated by the fund, such as dividends, interest, or capital gains. This share ownership structure provides investors with exposure to a diversified investment portfolio without the need to directly manage individual securities. Additionally, mutual fund shares are typically redeemable on any business day, providing investors with liquidity and flexibility to access their investment capital as needed. 5. Net asset value, NAV. The net asset value, NAV, serves as a crucial metric in understanding the value of mutual fund shares. Calculated daily based on the closing prices of the securities held in the fund's portfolio, the NAV represents the per-share value of the fund's assets after deducting its liabilities. Investors can monitor the NAV to assess the performance and valuation of their mutual fund investments. The NAV also serves as the price at which investors can buy or sell mutual fund shares, ensuring transparency and fairness in transactions. Understanding the NAV allows investors to make informed decisions about buying or selling mutual fund shares based on their investment objectives and market conditions. 6. Redemption options. Mutual funds offer investors flexibility in redeeming their shares, providing liquidity when needed. Investors can choose to redeem their shares partially or entirely, allowing them to access their investment capital based on the fund's current net asset value, NAV. This redemption flexibility enables investors to respond to changing financial needs or market conditions, providing a level of liquidity that may not be readily available with other investment vehicles. Whether it's for short-term cash needs or strategic portfolio adjustments, the redemption options offered by mutual funds empower investors to tailor their investment holdings to meet their evolving financial objectives. 7. Regular reporting and disclosure. Mutual funds are required to provide investors with regular reports and disclosures, fostering transparency and accountability. These reports include essential information such as the fund's performance, holdings, expenses, and investment objectives. By accessing these reports, investors gain valuable insights into the fund's operations, allowing them to assess its performance in alignment with their investment goals. Additionally, mutual funds are subject to regulatory oversight, ensuring compliance with applicable laws and regulations and providing investors with confidence in the integrity and reliability of the fund's operations. 8. Distribution of income and capital gains. Mutual funds may distribute income and capital gains generated from their investments to shareholders periodically. Income distributions typically include dividends from stocks and interest from bonds held within the fund's portfolio. Capital gains distributions result from the sale of securities within the fund at a profit. These distributions are typically made annually or semi-annually and are subject to taxation based on the investor's tax status and the type of account in which the mutual fund is held. By distributing income and capital gains to investors, mutual funds provide a regular stream of investment returns, enhancing the fund's overall appeal to income-seeking investors. 9. Tax efficiency. Mutual funds offer tax-efficient investment options for investors seeking to optimize their after-tax returns. Fund managers employ various tax-saving strategies, such as tax loss harvesting and minimizing portfolio turnover, to mitigate the tax consequences of investment transactions. Additionally, certain types of mutual funds, such as index funds and exchange-traded funds, ETFs, are structured to be inherently tax-efficient due to their passive management approach and low portfolio turnover. By minimizing taxable events and maximizing after-tax returns, tax-efficient mutual funds help investors preserve more of their investment gains and achieve their long-term financial objectives more effectively. 10. Regulatory oversight and investor protection. Mutual funds are subject to regulatory oversight by government agencies such as the Securities and Exchange Commission, SEC, in the United States. Regulatory oversight ensures that mutual funds operate within established legal frameworks and adhere to industry standards and best practices. Additionally, regulatory agencies work to protect investor interests by enforcing transparency, fair dealing, and disclosure requirements. Investors benefit from regulatory oversight through enhanced transparency, accountability, and investor protection measures, which contribute to the overall integrity and stability of the mutual fund industry. By investing in regulated mutual funds, investors can have confidence in the legitimacy and reliability of their investment vehicles, fostering trust and credibility in the financial markets. Mutual funds offer investors a convenient and effective way to access diversified investment portfolios managed by professionals. By understanding how mutual funds work and their role in shaping investment strategies, investors can make informed decisions aligned with their financial goals. In the full video, we'll delve deeper into the types of mutual funds, key considerations for investors, and tips for building a well-rounded investment portfolio. Ready to explore the world of mutual funds and enhance your investment knowledge? Click here to access the full video. Don't forget to like, subscribe, and ring the notification bell for more valuable insights on personal finance and wealth building. Your journey to financial empowerment begins with a single click. We'll see you in the next video, and as always, stay financially savvy.